someone sitting there saying, if I can put in $100,000 or $50,000 or some amount of money, $25,000 is usually the lowest that we'll do, is like put that into something and then just bank on the fact it's going to produce a distribution rate over 3 to 5 years with some reliability and consistency that you can stack that up over time. I'm happy to take a little bit lower and actually have that be something I can lean on.
Welcome to the Business Ownership Podcast, brought to you by Awareness Strategies, helping you navigate the waters between entrepreneurship and ownership. Hey there, peeps. This is Michelle Nedluck, and I'm super glad that you're here with us today because I'm here with my most amazing guest, Spencer. Spencer, thank you so much for being here with us today.
Wonderful way to start the day. Thank you so much for having me here, Michelle. Really excited about it.
Awesome. So give us a highlight of who you are and what you do for business.
Yeah, happy to. And so these days I wake up every day very happy to serve our investors. So I run a passive investing group at Madison Investing. So we help folks invest in real estate, big apartment buildings, self-storage facilities, niche stuff, well, the stuff that some people know about and most people don't, but it's very much changed our circumstances and our family's life. So I could be a more present dad. And I used to be in technology companies for 13 years. So that's kind of where I got scared into after growing up in a real estate household. My dad was a broker for 30 years in the Bay Area, and he was making me work jobs, like many parents and entrepreneurs do. And so that's why I ran screaming into tech companies for 13 years. And it's not nearly as cool to tell your friends you're going to go clean out an old fridge at a rental property, right? And so,
some of the experiences I've had, they are noteworthy. I'm not a fan of them. I wouldn't want to do it again if my life depended on it. But,
right, and maybe we can have some time to talk about that after we record today. But I think for the sake of what I wake up and do every day now, just feel very blessed to be able to kind of help other people find the path that we did. And working 18 hours a day in high growth tech companies might sound glamorous, but at the same time, being able to go and invest forward, create a financial moat around our family and help other people do that. That's what we do.
I love it. So what made you decide to go from tech and back into real estate?
Gosh, I would say that there was some formative moments. I don't have time for all of them, but I would say that, we all kind of got into this, those of us that went the corporate ladder. Mm-hmm. I climbed that ladder, was leading teams of over 200 people, probably way ahead of the time I should have been in my 20s. And that's how you learn. You get ahead over your skis, and then you get your scrapes and bruises. And ultimately, I realized about 13 years in, actually about 12 years into that career, I didn't see my infant son, our first of two boys, in weeks. I was going in too early. I was leaving too late. And it was exciting and fun to build companies, but there's no off-ramp that's well established for these Silicon Valley tech companies, Michelle. I mean, it's really like kind of the unwritten Silicon Valley lottery, if you will. People sign up to work in what will be the next Google, what will be the next Facebook, hoping that they're going to get this massive exit. And then, a check with many zeros will magically fall from the proverbial sky. And in the end, that doesn't really happen for the vast majority of employees working in that environment, even when you're in leadership levels, right? And I had to find a different way. And I think ultimately, not to go too deep on this, but I will say, talking about entrepreneurship, I think about it was a very tough decade in my teenage years, watching my dad's business, the only source of income coming into our household when I was working for him. And, lost my younger brother to cancer, lost a bunch of other folks in our family, really hard times. And I won't go TMI into that beyond that, but I'll say that really left a mark on me. Mm-hmm. What happens in a household where you've got one earner, and the lifestyle downgrade was massive from at that point in time. And I think looking at like, what is active income versus really passive income? How can I do this differently? I didn't know how to digest all that at that time when I was younger. Flash forward to a career where I'm like sitting there now having two kids of my own, working 18 hours a day, thinking maxing out a 401k is going to somehow solve this next 30 years. Because, I'm in my 40s now, but I would say that I still had some years and runway ahead of me, and still do now, I'd like to think. And there had to be a different way to do this. And so that's what prompted me to get myself refocused, to wake up earlier, start studying outside the office, to start running into this investing and private investing real estate world, because there's just endless wonderful ways to get inspired and go build something that the market will pay you back for as you serve others. Not to get too philosophical about the value that we can build in business that also generates profits in the world for those and for ourselves and others. But that was really it.
I love it. And we will definitely get into those points, because I think it is becoming more and more important to people that it is a win-win situation. But let's talk about the timeliness of this, because I know a lot of people, the biggest concern is now's not the right time. I should have done it 20 years ago. I don't have the money for it now. Is now the right time to get into these kind of investments?
There was a piece of wisdom that I heard, two of them, two bullet points. I'm a bullet point framework guy. And they stuck with me, and they still do. And I revisit them in these moments now more than ever, because volatility scares everyone. It just creates this blanket of fear. It hits all of us. Like, I'm not impervious to that. No one is. We're humans. So I think of the first one being that always be investing. And that inherently, most of my mind would have gone to back in my 20s, early 30s, before I thought, well, that means maybe I should just always be investing in my 401k. Perhaps I go buy some index funds, right? It's not necessarily what that means. It's a little higher level. It means think about one's own objectives. Do I have a full-time job with great income? Do I need to go actually generate income in form of cash flow or dividends back to myself? Well, no. So maybe it's something else. Not to go too long on it, I'll just say that the other principle is there's no such thing as bad assets. There's only bad prices. And so that if someone really, I challenge anyone out there hearing that to if you haven't heard that before, I did not come up with that. I can't take credit for that. It's just the best darn investing phrase I've ever heard in my entire life. And I cannot find another one, because whether it's like, take these AirPods I'm holding up on the camera, sorry for the podcast version of those, or it's, a computer, or it's a piece of stock, or it's a piece of real estate. Everything out there has a price. And what really matters is someone understanding what they're willing to pay in order to buy that asset. And so every market context has great opportunities. One just has to pay attention and educate themselves. And I read 24 books when I was getting into this, 24 books in 18 months. No one else needs to go out and do that. That was over the top. That was a borderline obsessive. But I would just say, there's so many wonderful resources at our disposal now, Michelle, right? I mean, like you can go online, find endless blogs, great podcasts like the one we're on right now. You're putting content out to educate people about how they can go find different paths in life. And I can't believe I'm saying this now, because the corporate dude in me from years ago would have heard this phrase and probably said, like, you're insane. But I firmly believe that going out on one's own and carving, whether it's your own investing strategy or it's building your own side hustle and maybe turning that into a full hustle, those are far less risky strategies for a person who's growing a family, who's building a life over a long enough time horizon, than devoting your only sole income to an employer that you have no control over. And so, not to get too dramatic too fast, but it's a journey to get to these headspaces. And I think that there's no such thing as bad assets. There's only bad prices.
I love it. So let's go into looking at kind of what your portfolio tends to incorporate and why you've gone there.
Yeah, I'm happy to. Initially, Jennifer Morimoto, who's actually my wife and my co-founder, which is like its own separate podcast. But nice. we were both in our own separate careers, and we started the way that most people do when it comes to buying hard assets or like real estate, which is too scared to go buy something far away we can't see. Mm-hmm. Keep it local. It's one of those long-term platitudes we've all heard around the dinner table for generation after generation. And there's some value to that. We drove around all summer with our infant firstborn in the car the first time we bought a rental. It took us the whole summer. We paid $430,000 for a duplex just north of the Bay Area. That has gone up a lot. That was cheap at that time. Mind-blowing compared to the Midwest and other parts of the US, at least. I'm sure that around Calgary, you've got some other price points that fluctuate. But we wanted cash flow, but we didn't really know what that meant. That property generates around $200 a month in cash flow. That means after everything else is paid off, taxes, insurance, property management, all that stuff, that equation is not what you call a home run for an investment. If you're wanting cash flow, we didn't get it. So that was phase one. Phase two, in hindsight, it seems all clear. I can break it into 3 phases. We went and said, okay, that dollar was not stretched far enough. So we went and bought 5 properties. We got up to 5 in the Midwest of the United States, Kansas City, Missouri, $60,000 per property, US, and $250 per month in cash flow. That sounds amazing. And it sounded amazing. And we bought those and we've sold them since. Did they generate profit? Yes. Was it a heck of a lot more work than anyone could imagine, even with a property manager? Absolutely.
I was going to say, and I'm going to go back to your Bay Area one, going, at least you cash flowed $200, because I think you're ahead of a lot of people. Yeah, exactly. Hands up. Congratulations. Because
thank you for saying
that is huge. Now, they're still under the bar from where you've taken it, which is, certainly get into that, because I think that credit where credit is due is important, and being able to identify those properties that are cash flowing, that are getting the returns, clearly is one of your fortes. And being able to even start off with, it was cash flowing, but it wasn't great. How do we make it great is an important mindset to keep in mind.
Yeah. Thank you for that. It's a journey that sounds like clean cut in the hindsight, like everything else in life, right?
Exactly.
Figurative machete in hand, chopping through the learnings along every way. Scrapes and bruises still intact. But we finally got to this point where we said, here's where we're at that point. We'd gone through those first 2 phases, and we said, both of us enjoyed our active work. We're not planning on, when we all think of retiring, could we retire in a traditional sense now? I cannot believe I'm saying this, but yes, we could. Are we going to sit around on a beach? Well, no, it's boring. It's so boring. The life is built for challenge and adventure, and not to be too corny. And so we said, let's go figure out a way to keep doing our active jobs. This is in around 2018. We started investing in bigger buildings, along with partners who could do the stuff that I don't know how to do. I can't swing a hammer, Michelle. Like I learn stuff on YouTube every day. My wife is more handy with the hammer than I am. And I'm very comfortable saying that. So I'm not going to go manage a big building, but we looked upmarket. We went and started finding partners who could be based in Texas, in let's say South Carolina, North Carolina, basically everywhere outside of the state that I love and live in currently, because that's where we saw cash flow. We could go and take that dollar, put it somewhere else, have it professionally managed, and then improve that thing, and then maybe sell it later at a profit. And so now we've done that dozens of times. And the ability to go buy a piece of something bigger instead of wanting that one smaller property just for ourselves was pretty mind-blowing for us at the time. Because when the occupancy at our single family rentals would go from 100% to 0 overnight when one person leaves, that would be a stressor. When you go up to an apartment building that's 400 units large and it's an apartment community in the middle of Dallas, Texas, you don't sweat it as much when one tenant leaves out of 400 and you're down to 399. And so that lesson really clicked. I'm an operations guy by trade, professionally, from my prior life and scaling teams. And I think I like predictability wherever I can get it. Is there risk in these things? There always is. Of course, they're investments, and we're heading into volatile times, but we picked relatively boring sounding assets by choice, because they actually produce stability. And I like that. Self-storage facilities, you talk about people thinking they're boring. As of 2023, Michelle, I'll tell you, boring is pretty darn sexy right now for most of the market. So
right,
a lot more interest in these now.
Well, yeah. So numerically, let's go back to kind of your skill set of, let's talk about consistency versus cash flow. When somebody's looking at a piece of property and they're just going cash flow, cash flow, cash flow, they tend to be thinking, I want, bigger, more. And then when they're looking at consistency, going back to your point of, well, that's boring. Long-term, what kind of difference do the numbers tend to fit into? How important is it for you to look at consistency over cash flow?
Yeah.
As a thing.
Yeah, no, that's an excellent question. I want to couch it from a perspective of a guy who's surrounded by all this, so many brilliant, way smarter people than I am here in Silicon Valley. We have investors of our own, senior software engineers at Meta, formerly Facebook. These are folks that could run circles around me with every possible algorithm they want to run. And when I sit there and I wrestle with these types of questions with them, why are you investing in an angel investment in a tech company? And they walk through the math of the potential. And the potential always looks incredible. It looks mind-blowingly incredible, right? Double digit, put your money in 5 to 6 years from then, you're going to have like 12x or 12 times or 20 times your money. What's really important, though, is what I think about as the risk-adjusted return. Clearly, I'm not being very original saying that, but to really sit there with that phrase and understand it. Someone sitting there saying, if I can put in $100,000 or $50,000 or some amount of money, $25,000 is usually the lowest that we'll do, is like put that into something and then just bank on the fact it's going to produce a distribution rate over 3 to 5 years with some reliability and consistency that you can stack that up over time. I'm happy to take a little bit lower and actually have that be something I can lean on, and that our investors can lean on. So I don't want to get myself in trouble for quoting too many actual.
So I am not registered and I am not licensed. I'm not anything else. But what I will tell you is I had a property once that had a cash flow of $1,800 a month, which sounds fantastic.
Yes.
When I sold the property, I was down 20,000 overall. That is not a good investment.
Right. Gosh. Thank you for putting real numbers to it. I mean, I'll what I can say with full disclosure is like, historically, for all of the deals that we've exited to date, I can share those. I mean, we've done 13 large property exits to date. So these are hundreds and hundreds of units for self-storage facilities and for apartment communities across the Sun Belt in the United States, from Texas stretching up to North Carolina. And we've done that 13 times. We have now seen, on average, 2.7 years is how long that was held. The investor puts in their money, I put in my money, we exit. And you're looking at, I think, 27% IRR, internal rate of return on that. So people are very pleased, and along the way they got returns and cash flow.
What? They're very pleased with 27%. That's
yeah. I mean, it's
awesome.
it's pretty darn stellar, right? And like, right? I mean, the caveat, of course, for people is like, taking the leap is the hardest part for most investors, and just knowing where they're at when they got to go and pull the trigger on doing it, because it's intimidating. Like, I really get it. Most people are not going to get to the point where they can understand what you just said is so helpful and so eloquent. Like, the $1,800 a month is an outstanding dollar amount for cash flow. But selling at a loss overall, looking holistically in retrospect, if you're a growth minded investor, you're going to say, well, probably not great.
Probably not. Experientially, it was very valuable to me.
Right. I appreciate that example. Can I give you one very brief, quick one that's like a firsthand example as a passive investor? So, 2018, invested in a really great looking 2-property portfolio in Alabama with people I trust, competent partners, and they did everything they could right. And within it was supposed to be an 8-year hold. That means my money is tied up for 8 years in this deal. We received cash flow distributions along the way. So I was ready for a long ride. And in the first quarter, we had just received our first quarterly distribution. We get an email saying, hey guys, I'm sorry. Turns out a very large tree fell on one of the 2 buildings. And that early in the deal, that means that this team is going to buy these 2 properties with a bunch of cash that all the investors, myself included, went in with a great plan, renovate them, put in new management, sell them at the end after receiving cash flow on the way. Big tree fell. And my only thought is blame the arborist that they didn't hire. Maybe, I don't know. But in the end, what happened? Well, we didn't get any more distributions for 3 years, actually 2.5 years. And then it exited with more than double the money on year 3. And so, bad investment? Absolutely not. Great investment. Did it do exactly what we wanted? No, it didn't distribute the cash flow along the way. And that was a bummer. I'm not going to complain about doubling my money in 3 years.
Right.
So,
right. Well, and that also comes to a kind of wherever your risk evaluation is, to be able to understand that if you're going to play a high risk game, you have to play a longer term.
yes.
Well, yeah, you have to be willing to play the longer term to be able to overcome that potential downside. Obviously, if it cranks up really quickly after a drop, then you're like, oh, okay, well, let's get out of this game. But the willingness. So let's talk about the willingness of somebody, because I heard somebody once want to say, well, when I was teaching entrepreneurs, it's like you have to be willing to go bankrupt in order to be able to set this business up. It doesn't mean you will. It doesn't mean you have to. Please
Right.
don't.
Yeah.
But the willingness has to be there. Otherwise, you're fighting it every step of the way. And if you're fighting it every step of the way, just go get a job.
Gosh,
So when
yeah.
it comes to investments, how do you see that playing out?
Getting to that point of willingness, gosh, everyone has their own mental model. It makes it sound so much more fancy than it needs to be, probably, right? That's a tech company term for you. It's like a framework. How do we make decisions? And the way you make decisions, Michelle, versus me and everyone else in the world, it's a little bit different. Jennifer and I sat down there and we took this to such a nerdy degree. And it's simple, so it's easy to articulate, but I'll say that I encourage most people to sit there and do it too, because you got to build your criteria. I like frameworks. This is what I borrowed from the people way smarter than me in tech companies, that came from these brilliant academic pedigrees. I mean, I went to University of Colorado Boulder, go Buffs, and I learned how to snowboard and drink beer there. But in the end, it comes down to the who, the where, and the business plan, or everything else. When evaluating any type of real estate investment where you're not hands-on active yourself. Like if you're not the one pulling the strings, pulling the levers, doing the work, and you just want to give money to someone and trust them, I didn't come up with that framework. That's someone way smarter than me years ago came up with that framework, the who, the where, and everything else. Beneath that, I would put more than 90%, 95, 99, pick a percentage above 90, of the relative weight and vetting on one of these things on the who. And as an experienced investor, which it sounds like you've already had your journey on this one so far, and probably have more to share than we can get into here. But the vetting on the who is just quintessential. It is everything, because you're asking this pilot, the person driving, decisioning this team to do everything. You're signing a big legal document to get into these deals. Therefore, being able to have a framework behind that was what we identified. And so we put together this nerdy 5-part framework. We look at the track record, meaning, has this person done this before? How did it go? What is their approach? What does that mean? That means whether I'm going to learn how to play a guitar song on my guitar, which I'm not too sharp on these days, I just play for our kids, or if I'm learning how to go, run, go on a better jog, or someone's playing sports, they want to learn how to swing the baseball bat better. You do something enough, you have a repeatable process. Same thing in business. Anyone that you're going to go put your money in, they're going to have a repeatable process if they've done it. And if they don't have a repeatable process on paper, they don't know it well enough. So approach matters, the team, the way they communicate to people. And then this sounds corny to a lot of folks, but I really stand by it, and that's their values. So it's you can do, the corporate folks will understand this and appreciate this as well, but behavioral interviewing is not new. There's stuff that you can really dig into with people about how they've handled certain situations. And when you're investing in stuff like apartment buildings, there's humans that live in these buildings, real humans and families. I've met them, and I've lived in apartments, most of us have. And so yeah, that matters. There's a lot of people who just buy things and try to improve them for a profit, and we do care about that. This is still a for-profit endeavor, of course, but that stuff matters, And so all of those things helped us get comfortable. I think that other people will have to define what matters to them relative. And I think, for better or worse, more than half of our current investors in our club right now, they are very quantitative. We're talking engineers, software engineers, hardware folks, people that are incredible quantitatives, and they will spend 99% of their review time on the spreadsheet. Don't ignore the spreadsheet. Got it. Absolutely reallocate that time to who you're putting your money with and do that first, and then worry about the darn spreadsheet, because I think that's where they get hung up, is they stare at things like IRR and they compare deal A, deal B, deal A, great IRR, deal B, not as good IRR. I don't think they stopped to check that deal A is being marketed by a person who left a coaching program 5 months ago and is doing it for the first time, so not to go too nerdy too fast, but I'll just say that's the big way that people can get comfortable more so, is think about how to go and set one's own criteria before they make investing decisions in any type of asset. not necessarily just real estate stuff like you and I appreciate, Michelle.
Absolutely, I do. And I got another story for that one too. So when it comes to you investing in pieces, if you want to call it, and I say, are you guys going after and looking at kind of who's managing the buildings right now, who's taking care of all of those things, what are their track records, and then coming back to your clients and going, hey, here's what we're looking at and this what's going on, or how does that process play out?
Absolutely. Yeah. This was a bit of the genesis for our specific business too. It was like, we were just investing passively ourselves,
Yep.
Going about our careers and lives. And then eventually over time, it oftentimes starts with friends and family, and they say, oh, what are you putting your capital in? What are you investing in? That happens so often. And everyone's like, man, I'm not going to get on a plane. So it's those moments that are formative and you pay attention. And I took note of that, and ultimately definitely spent, I wasn't joking before we hit record today. It was 4 states in the past week and a half, and that's not typical. I'm not on a plane that much usually. I was speaking at a conference, but I did travel to 3 different states just in the past week to go and visit and meet on site with a management team that we're working with now, of the 9 that we work with, and also look at some of the assets in functioning and in the markets that we were working in. And so taking the time to go see that stuff, to taking the time to say, oh, this exists. First and foremost, like, please tell me this thing we're going to invest in exists. It has an address,
Right.
and I'm not making light of it, but I think folks out there.
Hey, I'm every mistake that's ever been made in real estate that people are like, hey, you should watch out for this. It's because it's happened to somebody before.
Completely, completely,
Yeah.
And then so skimping by on that stuff, there's times that I'm reminded if and when I've ever done that in the past, and like it's not a shortcut that we're comfortable with. And so I will get on planes, shake hands, look at the financial stability of the people that we're working with themselves, in addition to their entity.
Nice, I love it, and hugely important, because my other story is we another real estate purchase we made, or investment we made, was in raw land that was about to be annexed by a city that was growing. Prime opportunity was the next piece, kind of the barbed wire over. There were already developers in talks about kind of how they were going to build out in that area. It was promising. And then all of a sudden something hit, which often does. And you're like, okay, so it'll probably be a 5-year delay. Fine. So all you really have to do is pay taxes at that point. But what happened was that the majority shareholders had basically refinanced that section of land in order to buy a section of land next to it, and kind of got greedy. And essentially, because of that 5-year waiting list, now they couldn't afford the taxes on it. So the land ended up being, they lost it all.
Oh,
so
man. It's a learning moment, I'm sorry about that.
Telling you, we learn these things. Well, but I think the downplays are important to understand, because it comes back to this value of who is the asset owner, who's playing the game. Do they have a tendency to get greedy and go overboard? And it's not necessarily that you're looking for, hey, have you been greedy and lost it before? It's, okay, so when this is going well, what did you do? Oh, we bought lots of land around it. That works great in some cases, but it just worked very badly when something goes wrong, like a tree lands on your property and you're not expecting that. So to me, when you're going to invest in any new venture, really, but particularly real estate, it's really understanding who that team is, what their values are. Are they going for the long-term play? Are they looking to make a quick dollar? All of the kind of too good to be trues really do come into play with these things, and you have to understand how. And to me, investing in real estate and the stability and the consistency is really what people need, especially if they're too late in the game, or they feel like they're too late in the game.
Gosh, that was so well said. I'm so tempted to grab on every single point you just made, but yeah, because I just looked to nerd out on this stuff. Very well said.
All right. Good. I'm glad we're on the same page. So tell us a bit about what you got going on in your business right now, and who can benefit from it most.
Yeah, I think now more than ever, feeling very reaffirmed because of all the crazy volatility occurring out there right now, or is perceived as crazy, just some of the banking stuff that's been breaking the news in the past week. But I would say that reaffirmed in the fact that boring is the new sexy, not to be too cheesy. So very excited about things such as, welcoming new members to our group. We've done this on a very lean basis by design. I used to scale up tech teams very large, and I learned that this phase of my life is all about working with a tight-knit group of people and then partnering with experts who have great infrastructure for their big buildings, and experience. So I personally onboard every new member myself, build a long-term relationship with them. Right now, we're looking at like self-storage facilities and funds because they're great, and Americans love to store our stuff in big units that we don't look at for years. As it turns out, that's a really good business model.
Right.
So, and there's no people living in the units, ideally, fingers crossed. Apartments as well. But I think that stuff right now, hard assets, there's a demand. People need places to live, and people need places to put their stuff. A couple other niche assets that we look at too, but that it tends to get a little bit more boring for some folks. You don't want to go look at the niche stuff beyond that. But that's really more of that, and then also just talking about goal setting with our investors, because it's a good time to pencil and rethink and sharpen one's pencil, as it were. What is someone's goals right now? With all the movement in the economy and the movement in the job landscape, if someone has changes to their household structure in terms of who's bringing in what income and from where, just trying to be a resource and helpful for folks as they're doing that.
I love it. Well, and I do think from my experience, and you will obviously have way more data on this than I do, is the whole notion of people moving from single dwelling homes into apartments and or multi-family units is a trend, and they're downsizing, but they're not getting rid of their stuff. So it makes sense that they're going to want to have those self-storage units to be able to accommodate that as well.
Oh yes, it's a very interesting, almost they're like two sister asset classes in that way, and I think that the downsizing dynamic is spot on for the data and the observations that we've seen in a number of different markets. And so I think right now more than ever, it's about also job freedom and where are the jobs moving? Like jobs are the big guide. If I had to boil it down to one thing, I have 70-point criteria listed in every spreadsheet of stuff that we go through on these opportunities. But I would say, if I had to boil it down to a single word about what gives confidence in a market, what is the ultimate kind of moat in the market dynamics that someone can build around a place where they're going to deploy into an asset that's sitting and has an address, it comes down to where the employers expected to go, and then where are the jobs stable, and that's not necessarily always going to be, for example, Silicon Valley, where I live. That's why we don't invest in real estate here. Places where employers are moving, job stability, great markets that are a bit more owner friendly, all those things.
Yeah, I love that. So can you give us an example of a Cinderella story of one of your clients? Without naming names, obviously.
Yeah, no, I'm happy to.
Nice.
we have it's actually like become quite a good friend. And he was at a tech company for many years, and ultimately was deciding when and how he could decide to just leave and pull the ripcord, or whatever analogy someone wants to use, to just retire and become a passive investor so he can go enjoy life more. And so I didn't realize this at the time. He told me a couple of years into our relationship, but he's now invested over 7 figures through our club with us. We're very proud of how that's gone for him. And when we were over here like having coffee the other day, he like tells me, he's like, "Man, did you know that you're like the first person that I heard talk about this stuff before?" And this was before he ever did any of it and made his first investment, but he like didn't tell me that for years. And so it was very touching, and I just never really knew that until recently. So yeah, I'll keep it anonymous, although I don't know, he would probably like it if I brought him up. But yeah, he worked in tech for about 15 years, 20 years, and then decided, oh, I can actually go do this whole retire on my own terms, passive income thing. And now he's living that. And so yeah, I don't want to mention his name and get in trouble.
All good. All good. So what are some of the stumbling blocks that somebody might be having that's listening to this right now and going, "Oh my God, Spencer, I need you so badly"? Or
Yeah.
want you?
Well, I will say that not everyone can invest in them, and I do wish that more people could get the access to these types of private real estate deals, because when I say private, of course, for folks that are out there, it means like you're not going to find a stock you can buy in the stock market for these, and there's a bunch of different ways and flavors to do this, and there's other types that beyond what we do here too. I'm not the guy that says myopically go do just what we do investing wise. But go find what works for someone's circumstances. And so the obstacles would be, most of the time you will have to meet accredited investor requirements. And what that means, if you're going to invest in these bigger deals, is the SEC says you have to meet these income or these net worth requirements. And so that is a barrier. There are ways for folks to do that if they're not accredited. We just can't accept it at Madison Investing because we are held to this registration standard.
Assuming somebody's credited, they have their assets in place and they're going, hey, this all sounds great. Yeah. I know our listeners are going to want more from you is what I'm trying to say. So how did they start that journey with you?
Yeah, so they can just go to madisoninvesting.com. So if you're Madison companies out there, so it's just named after the street where we actually had our first home. So it wasn't pulled out of thin air. There's a story behind it. But it's madisoninvesting.com. We have a newsletter, but folks, if they are really eager to just kind of learn more, they can sign right up to join and request an invite for our investor club.
Nice. Love it. So I get to ask you, at what point in life did you know you're special kind of crazy enough to think that you could become an entrepreneur?
Oh, man, way too late. I would say in 2016, I was managing a team and I saw from like 6 p.m. to about 8 p.m. at night, after hours, my employees, small group of employees, would be working hard on a side project. And I was like, how are they doing so well in their day jobs? These are the folks that worked for me directly. And then they, 5 years later, over the period of time, now run a massive, like impressive rental portfolio company out in Texas. Those early days when I saw them doing that, I was like, if they're doing that, I can do that. And I saw my dad do it, but apparently there's something contrarian about not wanting to be like our parents.
Nobody wants to do what their dad does.
Yeah, exactly.
Dad doesn't know anything.
I'll do it my way, right? Exactly. But that really had to be it, Michelle. It was that seeing others in my peer group and that I respected greatly, knowing what makes it so that they can do it, but I can't. And that was huge.
I love it. You have been absolutely awesome. Any last words for our peeps?
Yeah, I would just say, get curious about this stuff. If all of this sounded like it was completely boring, you're like, what is Michelle and Spencer talking about with like big buildings? Get curious. I would say if you're not happy with your circumstances, if you want to get more out of the prosperity of life financially, just get curious and go read. And money doesn't have to be boring, and finance does not have to be boring. I thought it was super boring in college, but everyone can get something out of it. And so we are also, by the way, offering. We have a free new guide we just launched. It's like the seven ways to become a passive investor. It's called the Blueprint for Passive Investors, and folks can sign up for that on our website as well.
Very cool. Awesome. So peeps, go and check that out. Spencer, thank you so much for your time. I appreciate it. And I know how valuable it is.
Yeah. And then likewise, thank you, Michelle. This is a blast. Thank you.
Awesome. Peeps, thank you for being here with us today. Be sure to subscribe to the show and share it with your friends. We love helping entrepreneurs grow.
Are you running a business over 7 figures but still struggling with technology headaches? Pay attention. You do not want to miss this offer. This podcast episode is brought to you by Awareness Strategies, who is offering a custom-built digital adoption roadmap for anyone running a business over 7 figures who's wanting to grow their business in the next 5 years. And it's not just a roadmap. They offer full implementation as well if that scares the out of you. Check out awarenessstrategies.com/roadmap for more details today. The link's in the show's notes. Don't regret not doing this. Do it now. That's awarenessstrategies.com/roadmap.